Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Tuesday, May 17th, 2022. Beautiful day outside. Hope you're all having a great week. Back to update you on the markets. We had some recent economic data released today and earlier yesterday. We want to discuss that. We had some comments from the money printing rock star Jay Powell talking about fighting inflation that they created. So let's wrap it all up into a market update for you, give you some of our thoughts and expanded views on this market. So first, let's take a look at the market. Here's the S&P 500 over the last 9 months. Markets traveled right down below that 4,000 level, right between 3950, 4,000, which was one of the levels we had keyed on when the market was unable to break out to new intermediate term highs, and the market bounced right out of that level. So that's a good sign. We've had a nice rally over the last 3 of the last 4 days. Very nice rally. Remains to be seen. Is this just a bear market rally, a dead cat bounce, if you will, as some technicians will call it? But I think we'll get a little bit more follow through here, and it really won't be until we approach some of the previous resistance points that we discussed that the market really will be put to the test. Looking at the news flow today, we had two main things that we saw this morning that we felt were noteworthy. First was we had the monthly retail sales data, which was released, which itemizes and computates some of the retail spending data driven from the consumer side for the month of April. Now, a lot of folks just look at the headlines when these things are released, right? So when you look at this article here, you see retail spending increased by 0.9% in April, right? Boosted by demand and inflation. That's the key, right? So now a lot of people think, well, the consumer must be doing great. They're spending more money than they were previous months, right? Sounds good in a consumer-driven economy. However, very few people take the time to look through these reports and see where is this money being spent, how is this money being spent, and ultimately what are the effects, the knock-on effects that we expect to see in the economy. So we did the dirty work, we did the digging into the retail sales data, and let me just make this a little bit bigger, and I wanted to share this with you today. So when we look at the breakdown in retail spending, we see that from the month of March to the month of April, right? These are the two columns we're looking at here. Folks spent less money on motor vehicles and parts. Folks spent less money on electronics and appliances, so kind of let's call them discretionary purchases. Folks spent way less money on sporting goods, hobby type materials, musical instruments, bookstores. But where were the big increases? Food and food services, right? Tremendous increases. And I don't think, folks, this is because people are eating more. We know it's because the costs of these things have gone up. So we point this out because obviously we're all looking for clues to see when inflation will top out. And we need to look at some of the underlying reports to get a feel for that. So first we get this data, right? And we see that, okay, people are pulling back on discretionary spending and they're spending a little bit more on the essential items due to rising costs. So again, we don't like rising costs, but if we want to see inflation cool off, we need to see people's discretionary spending cool off a little bit with it. So we're getting some signs that higher prices are causing people to do that. A stock market correction will also cause people to do that, right? $20 trillion of global wealth has currently been misplaced or replaced during this correction. And while we anticipate it will make its way back to patient investors, that wealth effect has an effect on spending as well. Then we got a report, an earnings report today from Walmart, right? Walmart, I just had it up here a second ago. Bear with me. All right, well, it looks like CNBC updated their homepage, but basically Walmart reported a drop in sales attributable to higher prices through inflation. So Walmart is another very important pulse on the consumer economy. So some of those recessionary fears that people have started to hear about, some of that chatter that's starting to build after we had negative GDP data in Q1, starting to be reaffirmed a little bit with some slowing retail sales, and obviously Walmart with a retail sales miss. Now, I think in time this will be a very good investment opportunity for investors. Walmart is a fantastic stock, almost virtually recession-proof, But nonetheless, the way earnings seasons have been going this quarter, anyway, has been kind of sell first, ask questions later if companies don't meet those expectations set by analysts. So when we look at those two things, right, we see retail salespeople are slowing on the discretionary side, and then we see Walmart where they had a drop in sales. People are likely holding on to their money a little tighter and only spending on the vital goods, the non-discretionary items, right? So over time, I think that will translate, and when I say over time, maybe over the next month or two, I think it will translate into lower inflationary readings. Now, why is that important? Because Jay Powell spoke again today. I'm sure you folks are probably tired of hearing about this guy. To me, it's unbelievable how often the Federal Reserve is in front of a camera giving a press conference right now. We know it's part of their policy initiatives to talk policy into the markets, but I think we're all getting pretty sick and tired of it at this point. But nonetheless, Jay Powell basically acknowledged all the wrongs the Fed has made over the last year. They were slow to acknowledge inflation, they were slow to raise rates, but he's also acknowledging that the tightening in this economy has certainly taken hold, right? We've seen mortgage rates rise, and all of these things matter because, as we talked about last week, at some point, this wheel that's spinning towards more and more and more monetary tightening is going to start to reverse, and it's going to go back towards monetary loosening. And how that will happen will be inflation will peak, the Fed will be concerned about a recession, and they will likely put their plans on hold. So remains to be seen how that happens and when that happens, but we still anticipate that it will happen. So again, looking at the markets, right? Nice rally over the last 5 days. We want to see some follow through. That's been a characteristic of a nervous market, of a market in a downtrend, is that a lot of these rallies get sold into. Now, one of these times that will change, a rally will stick, investors will realize that stocks have come down enough and represent great value, and they will not be bailing on these rallies in short order. Looking at the rally today, we had a very broad-based rally. Let me just move myself out of the way here. Very broad-based rally. This is what you want to see. Mostly all sectors of the market rallying. And again, we've talked about how recently it's been a very defensive market where people really want nothing to do with growth. They're focusing more on the here and now stocks, the value stocks, the defensive stocks, and a little bit of an unwind in that today, right? Here's our consumer defensive stocks all down today, obviously queuing off that earnings miss from Walmart. It's not often, folks, you're going to see Walmart drop 11.4% in one day. But again, silver lining to everything. This may be a great investment for us, an opportunity, a couple weeks, if not months down the line. But you see all those retailers pulling back today. Target, Dollar Tree, Costco, didn't matter. When a company like Walmart misses, there's a lot of collateral damage. But broad rally across the board. Tech leads, semiconductors leading tech. These are the things that we want to see. Another thing I wanted to talk about briefly, we don't spend a lot of time talking about cryptocurrencies, but I thought this was important. I've had a few questions on it. Many of you have probably heard in the news about the implosion of one of these cryptocurrencies over the last 2 weeks. And I'm bringing this up not to pick on any investors. Hopefully none of our investors were anywhere near this thing. I know not on our doing or our guidance, but some of you may trade crypto on your own. But we saw this Luna coin, whatever it's called, be depegged, if you will, essentially breaking away from the dollar peg system and crashing to zero. $60 billion wiped out. Now, I bring this up because I think we all know that there were some signs of excesses in the markets last year, and this was one of them, okay? The way that this was advertised was that it was basically paying a, quote, risk-free rate of return of 20% per year guaranteed. Now, any of you that have been investing for a number of years, like us, have been involved with markets for decades, you know that there's nothing out there that's risk-free that earns 20%. Because if there was, we would all own it. We wouldn't even bother with the stock market anymore. And again, folks, if it seems too good to be true, it likely is, right? The old adage holds true yet again. So I hate to see investors get hurt. I hate to hear that $60 billion of people's capital was lost in a scam like this. But again, those were signs of excesses in the market. People thought that 20% a year was just a given. And unfortunately, a lot of people got hurt, but I think this is opening up investors' eyes. The air is coming out of the crypto balloon. And again, I'm not here to make a case for or against cryptocurrencies, but I think the case that people had made for Bitcoin and the likes, that it's an inflation hedge, that it's a store of value, that has just totally been blown to smithereens over the last couple months. Bitcoin is nothing more than a proxy on the stock market, and the rest of the cryptocurrencies in that space are the same. So again, just want to point this out because when corrections happen, when crashes happen, part of the reason they happen is we have excess froth in the market that needs to be blown out, and we are seeing signs that that is taking place. So again, whether we are at the bottom or just in a bear market rally that will see more selling, we're going to need a couple more days to tell, but we're getting a nice relief rally off some of the levels that we are keying on, and you're seeing the right stocks that are leading this move over the last couple of days. So again, any questions, of course, reach out to us. We wanted to give you an updated view on this economy with some more retail sales data that's now out. Talk to you a little bit about how the cryptocurrency implosion will likely benefit stocks over the longer term, as some of the luster and shine on the cryptocurrency space will likely fade and investors will come back to more traditional asset classes like stocks, right? And again, let's face it, crypto was hogging some money from the stock market last year, as everybody heard these anecdotal stories about everybody who was getting rich. So normalcy returns yet again. We want to see some follow through in this market. We'll have some more Fed speak. I know, more Fed speakers, right? We'll have more Fed governors speaking later this week, and we will update you on our findings in the Heritage Market Polls on Friday. So we hope you have a great day, and we will see you back later this week.